Financial statements. As noted previously, the job of accounting is to summarize the results of a firm's transaction and to issue reports to help managers make informed decisions. Among the most important reports are the financial statements, which fall into three broad categories: the balance sheet, income statement, and statements of cash flows. The statements of cash flows. While we discuss three types of financial statements as well as the function of the budget as an internal financial statement, we conclude by explaining the most important reporting practices and the standards that guide accountants in drawing up financial statement. Balance sheets. Balance sheets supply detailed information about accounting equation factors. Well, the accounting equation factors are assets, liabilities, and owner's equity because they also show a firm's financial condition at one point in time. They are sometimes called statement of financial position. Well, hypothetically, such a balance sheet is a perfect poster for the wholesalers. What are the assets? Assets, again, an asset is an economic resource that a company owns and from which it expects to get some future benefit. From an accounting statement point, most companies have three types of assets: the current assets, the fixed assets, and intangible assets. The current assets include the cash and assets that can be converted into cash within a year. They are normally listed in order of liquidity. The ease of converting them into cash, such as debts, for example, are usually paid in cash, and a company that needs but cannot generate cash, a company that's not liquid, may be forced to sell assets at reduced prices or even go out of business. By definition, cash is completely liquid. Marketable securities purchased as short term investments are slightly less liquid but can be sold quickly. These include stocks or bonds of other companies, government securities, money market certificates, and money market certificates. Many companies hold three other important non liquid assets: accounts receivable, merchandise inventory, and prepaid expenses. While accounts receivable are amounts due from customers who have purchased goods on credit. Most businesses expect to receive payments within 30 days of a sale. Allowance for doubtful accounts indicates $650 in receivable that perfect poster doesn't expect to collect. Total receivable assets are decreased accordingly. Merchandise inventory. Following accounts receivable on perfect posters, balance sheet is merchandise inventory. The cost of merchandise that has been acquired for sale to customers and still on hand. Accounting for the value of the inventories is difficult because they are always flowing in and out. We must therefore make assumptions about which one was sold and which one remained in storage. Prepaid expenses. While the prepaid expenses include supplies on hand and rent paid for the period to come, they are assets because they have been paid for and are available to the company. I beg your pardon, please. In all current assets as of December 31, 2004, for perfect posters, it totaled $57,210. Fixed assets. Fixed assets such as land, buildings, equipment have long term use or value. But as buildings and equipment wear out or become obsolete, their value decreases. Accountants use depreciation to spread the cost of an asset over the years of its useful life. To reflect decreasing value, the accountants and calculate the resulting amount of each year. Every year, therefore, remaining the value decreases on the books. Perfect process shows fixed assets of $107,880 after the depreciation occurred.